You're not making as much money as you want because you're chasing the wrong stuff. You're chasing opportunities instead of solving problems. A problem is what threatens the future of your livelihood of your trading. So it's also decreasing the likelihood for your trading to exist. I'm going to show you here a full trading strategy, how we solve these problems in our trading school, and I hope you can take something out. The first problem is to have enough trading signals. This is something what is very important, because if you have 20 to 40 or 80 opportunities, it is different than if you just have 5 trading opportunities and you're forced to take each time a trading opportunity. The second one is that you have a clear pattern. What I just named, that you have 20, 80 times a month would be good. What we use is the 1 minute chart and a color switch. That means just a red and a green candle, or a green and a red candle that closes. The third one is time efficiency. To trade only for 1 or 2 hours is very important, because trading more than 3 hours, being very highly concentrated, well, it depends, of course. Some traders are also like just maintenance, watching the market, and then concentrating, doing that focus session just when they see that the market is more pushy. But on our end, it's literally about just to trade 1 or 2 hours. And the fourth one is also about the money management. That what I really love is for this trading strategy to adjust $100, but then to make $500. This happens that when we have here the 1 minute chart, as you see here, that means here you can see here the red and the green candle. Entering the trade after the green candle, stop placement on the green candle, adjusting, buying so much in the future that it's $100. Please do this only with the demo account first. And then you can see here, this is a $650 trade, aiming for a high on the left side. It is very important to have data. And the thing is also, how is data changing your behavior? If you have data and data is not changing your behavior, or if it just makes you feel nice, I think this can be okay. But data should be actually changing your behavior. And instead of being overwhelmed by too much data, it's just important to have 2 or 3 key references to have enough data. When it comes to trading, you always have these 3 things, what I think are the most important things. The first one is the risk-reward ratio, and it's also important to cap that to a specific amount of move, what I'm going to show you with some example trades of some students. And it's very important to cap the risk-reward ratio. That means also to cap also winning trades, because that you have more winning trades that also succeed. Then it's also important to cap also losing trades with the risk-reward ratio. So that's the number one thing, is the money management. Second thing is trading opportunities. That means how many trading opportunities can you see in a direction when you see the market is pushing. And the third one is based on how the market is running, concentrating on 4 things. Those are 4 key points, how to find more qualitative days and also trades. This is not occurring every day, but if you sit down maybe for 2 times, 3 times a week using the 1 minute chart, you will see within 5 weeks, 5 days, 7 days, 8 days where the market is doing that. And you will find also very good trades, what we're going to talk about. So first of all, you can see here a trading student, how he has 9 winning trades and 7 losing trades. And he made $1,364, but he lost $700, so he made $664. You see here how the trader has 13 plus the 16. That means 29 trading opportunities within a month, as you can see here. And the trader is not just trading. You can see it says here on the right side, it says learn trade. It says SL, TP analysis. So the person is analyzing. You don't need to understand fully what it means. All you need to know is just like he has a lot of trading opportunities and he's thinking here. He has a specific thinking process, and then he's taking one trade. And then what he does is after a trade, he still continue to think. He's looking for more trading signals. So he's literally overwhelmed with trading signals if he would trade everything, but he's not trading every trading signal. You can see also how he trades also just like 2 or 3 hours is very important. Sometimes just 1 hour from 8 p.m. here, for example. You can see here 8 p.m. for example, from 7 p.m. here. And this is just like 1 or 2 hours always, like 5 p.m. you can see here to like here you see here to 7 p.m. for example, right? Like 1 or 2 hours is very important. Another participant you can see here also on calendar week is this one is 36 here. You can see here the trader has here 12 trading opportunities plus the 7 the trader took. And there were also more trading opportunities than you can even see here in the Excel sheet. But the trader is of course not listing everything. It's just like that you see when you have data, you want to make sure that it makes sense with these 4 things that are just named in the beginning. And I think like based on that, you can make way better decisions. What is also very important is that when having multiple trading signals, each trading signal and also strategy has always a drawdown. So that means sometimes it is the market, sometimes it's more the trading strategy. The thing is just that if we say, for example, we trade more the trend, because you have reversal trades and you have trend-based trades. If we have a trend-based trade and we have just a color switch using the 1 minute chart, and we are allowed to trade any colors which we want with these 4 leverage keys, with these 4 key points, what we're going to talk about soon. It's just like, you know exactly that you can track something, because if you do 10 times, for example, if you go to the gym, for example, and you lift weight and you do always the same exercise, you know next week or the week after how much weight you did last time. Were you increasing strength or like were you decreasing strength? And sometimes what can be, if you're consistent, do you need to make more resting, for example, because you're training too much? Or do you need to eat more to be more stronger? That has also something to do with the leverage. And this is exactly the same when it comes also to day trading. It is about to trade a color switch, to trade the trend, and to have 4 specific key points to find more high quality trades. So you find here, as I show you with the proof here, this trader here has 44 trading opportunities, 13 trades the trader took. So there was 57 trading opportunities. And you see on the right side how the trader is not trading every trading opportunity. It's literally about reading a lot and then trading only what makes sense. And for that, we have here many trading performances from students, and it all took them 3 to 7 months going to this point. So we're going now into the trading strategy here, and you see here how the trader trades here the color switch. That means a green and a red candle. To these 4 points, we had 4 points in the beginning. Very important for these 4 problems to solve, that our trading continues to exist, and it's also going to live longer, because it's not just to trade everything or else a burnout may occur. It may work for the first and the second or third year. But staying consistent with the trading strategy, it's really about consistency, mental health also, and also capital health, what is very important. So that means also we also need to cap trading losses. That means when the trader loses more than 2 times, for example, at a day, the trader needs to stop, because that would be $200. But if there's one winning trade of making $500, then the trader could continue, or he decides, for example, to end for the day and keep the money. So those are the 4 things, very important. Before starting with the 4 things that will increase trade quality, it's always very important to go to this single thing. That means when we start trading, we always want to understand, when we look at the timeline, how long do we have time to trade at? Because from here to here, if this is 1 hour, we look at the last 1 hour, how much move in average did the market do? And you can see here, there was one move in 1.5 hours that was this long, and there was one move in 1 hour that was this short here. That means within the next hour, it makes more sense that the market does around this move down or this move up, as you can see here, like right up or down. And maybe it makes also sense that the market does a longer move and maybe reaches also this high, what makes it realistic, because the market did this move. If the market is just like doing this moves, and we're just expecting we start trading that the market does this is quite unrealistic, because it's not too much trading the trend or based on information. It's more like when we see the market did this within 1 hour, then we can expect that the market continues to do a same length within 1 hour. And then maybe we can see here a small tiny color switch of a red and a green candle to adjust $100 to make $500. Also, to take in addition, there's something, an indicator that is called the anchored VWAP. And it means when we see a bit that the market is consolidating, as we see it here, it would make more sense to use the anchored VWAP. As you see here, this is this blue indicator, to place the stop under it and to enter after the market is above the anchored VWAP. And we use here the color switch, so red and the green candle, and the trader was entering after a second green candle, what is not that nice. We try always to enter the trade straight after a color switch, for example. So these 4 points are following things. First of all, for the 4 points to exist, it's very important with step number 1 that we see a clear reference where the market is going at. In this case, it was this high, as you just saw here in picture number 1. We see here the time from here to here was 1 hour. We compared the last hour. Does it make sense that the market goes to this high? And then you can see here how the trader was drawing also an arrow up to just show us clear for his trading journal. He expected in the beginning that the market goes up. And then for him, it's also money management. So he can already make the decision how many trades he wants to place. how many trades you want to place usually, and how the trade management is going is already decided in the first 5 to 10 minutes when we start our trading with the first impression. That means the trader says here with this picture, I can see the market is going up just in one direction, as you see here, not like up, down, up or something. It's just like up. And it shows the trader, I want to place here 2 trades because based on money management. And then you see here how the trader placed one trade. It worked with $470. That was the risk reward ratio of 4.7, and then just ends for the day. Very important is to have so many trading opportunities as possible. That means you see here red and a green candle, you see here red and a green candle, you see here red and a green candle, and you see here red and a green candle. So something that occurs very often here, also red and a green candle, is just to figure out then with all these color switches we see, which of these makes the most sense. And it is literally that when we have consolidating a bit more, when we have an anchor VWAP here, right? Because as I said, more consolidating, we need the anchor VWAP. We place it always on bigger structure on the lows here, you see here, like this. And then once the market is under it, we want to have our stop placement under the anchored VWAP. When the market starts to make a lot of green candles and it pushes here out, and we assume this is a medium structure, if we compress the market again, when it comes to viewing at the market, you can see here how this one works very well with the stop placement under the anchored VWAP that is cutting out quite aggressively. So we will look at more trades and then we talk about these 4 points. So first of all, you see here that it is a clear goal where we expect the market is going at. Point number 1 is we see more green than red candles. Here you see clearly more green than red candles. Point number 2 is you see obviously that the market does more length up, length up, length up, length up, then length down. Length down is just this short here, as you see here. It's shorter than so that means the black lines are longer than the orange lines, right? As you see here. The third point is you can see more candles going higher. That means here down here, you see just 3 candles here, 3. Here you see many, many massive candles. A lot of candles were shifting higher. And now check this out. Here you see again, more and more candles are going higher and higher. That means just like the market wants to shift higher. That's also the same when you look here on the left side, for example, lots of red candles. That's number 1, as I said, right? More length down than length up here. It's more up, starting here, it's more clear. That means here color switch, green, red, for example. Here you have a color switch. Here, green, red, green, red, green, red. So all these color switches are important. Very important is with this color switches that the color switch is small. That means when you can see here the color switch is closing down here, if you would adjust here $100, that's just $100 move. But if you have a very small color switch, as you see, for example, here, you adjust from here to here $100, or how the trader did here with the green candle, that's a $470 trade. Because if the market goes against us, it's $100. If the market goes for us, it's $470 or $500, as you see here with the risk reward ratio. We work always with entry, stop placement, and then we enter so much with the buying position until it's $100 to our stop placement on the same candle. And then if the market goes against us, we would lose 100. But if the market goes in our direction, each same length that would be $100 against us is literally $100. And it would be good to adjust it to $500. So, okay, very important is with these 4 points. I just named 3 points because in the 3 points that I just named with lots of green or red candles, more move in our direction than against, as I just said. And then also it does more candles higher, more candles higher. It is now very important also to understand that the 4th point is that when you contract the market, that means when you make the market small like this in the trading process, it is very important that you can see that it makes sense, as the trader was drawing here, that the market clearly wants to go higher. If this is not the case, a trade should not be executed is very important, because this is the first thing and the last thing we're looking at to execute the trade. And this is based also on experience by trading one market. If you would trade a second market or a second setup more than a color switch, that means just a green candle, for example. This trader has more experience, so the green candle was okay with the anchored VWAP and there was a color switch down here. But the thing is that if you would only trade a green or red candle, if you trade a second market, you will have a second drawdown. That means like a second losing streak. It is absolutely normal in trading that we can lose 5 to 7 or 8 times. And instead of losing now 10 or 14 or 20 times, we can decrease this by 50% by just concentrating on one single thing and one single account. Also, what is very important, when it comes to day trading. So let's look at more examples to that. And I hope it literally helps you to solve these problems in your trading, that you're not chasing opportunities, that you're looking also forward to solve problems. So here now you can see here how the market is going here down, does here a couple of red candles, does more length down than length up. And it does also down here. The market does here more candles down here than up here, right? So you can see how the market is shifting down. The thing is now, the problem is the market is here more higher in pressure when you contract the market, when you make it smaller. And that makes a lot of sense that the market cannot reach this target here. What the market will aim for are consolidation phases, as you see here a bit. That means this selling thing here down here, I think it's okay because a lot of red candles. It's just like to keep in mind that it makes sense that the market is not, the likelihood is a bit higher that the market is not reaching this high, this low, I mean. But here, for example, you can see a green and a red candle, and then it makes totally sense to trade to this consolidation phase, what the trader was also drawing in just very tiny here with this blue area, as you can see here. And everything what you can see here are color switches. Let's just go here to our next picture. Here you see lots of green candles, more move up than down. The trader is literally seeing that the market has here this high, has here consolidation phase where the market likes to go at. Or here this blue line, what is the 1-day VWAP, and you can see how the red and green candle occurs. And the trader trades there what was $375 with the risk reward ratio of 13 afterwards is very important, going for this high, right? Just because the trade is going 13 and it would have been maybe $1,300, it's important not to make the $1,300. It's more important to trade what you see makes sense where the market is going at, and then with experience always to just adjust it with the length. The thing is just that when the risk reward ratio of 5 has met, and you can see it makes sense that 1 to 5 makes sense, you make the trade of 1 to 5. And you see the trade is at 1 to 5. It's just important, I think, to exit so aggressive as possible as 1 to 5. Here, for example, you can see here how the trader assumes that the market is going to this low. You can see this on this drawing here that you see here. So this could be a $2,000, $3,000 move. The trader places the anchored VWAP because the market is a bit wiggling around on the very high structure. You can see here a couple of red candles kicking in. What is also very important, you can see here clearly with these 3 points, actually also 4 points, right? But the first 3 points are lots of red candles, more length down than length up. Here also lots of red candle, more length down here than up here. And then you can also see here that the market does down here more candles. There's down here more candles, right, than up here, for example. Just within, if you would just like look within one string, if you look in total, you can see here lower, lots of more candles. And then when you just look in reference to here, less candles. Here you can see, for example, again, more candles, right? You can see like how the market is shifting lower literally with like more candles. And then up here, it does less candles, and it does here red candles kicks in here again. Then number 4 is also when you contract the market, you can see here obviously that the market really wants to go down. This was also, as I just showed you here, the first impression of the trader. And then now we see here the color switch or the red candle adjusting $100. It would have been better for the beginner, of course, here first to trade the color switch here, or to take another color switch here. This is a bit of an experienced trader here. And then to enter the trade, adjust $100. The trader entered here the trade, adjusted here $100. And this was then with enough leverage, an $800 trade. It's not about making more money with more length. It's about just seeing length that makes sense and having a small candle where you see like, oh, when I adjust here $100, this could be $500. Here again, the same thing. First of all, trader sees that the market wants to go to this high, to this blue reference. Then we see it's contracting a bit, like it's having a consolidation, placing the anchor VWAP on the bottom. You can see how the market kicks in, does more green than red candles here, does more length up than length down. You can see down here are more candles. Yes, definitely. But the thing is, it's just like you see that the trader saw that the market is structuring up, and it's about like, not about every time the 3 steps, the 3 things are just neutral, like lots of green or red candles, more length in a direction, and also more candles in a specific like higher or lower price area. It's more about how strong are these 3 points to each other, and then to compare it with the first time and the last time with the 4 point is literally about like how much can we see that the market is going up here. And you can see on the black drawing what the trader drawed in before trading, like literally in the first 5 minutes, that the trader sees here obviously one direction, what helps the trader to trade in one direction. And you can see here adjusting $100, making here, this was a $400 trade with a risk reward ratio of 4. And then again, adjusting $100 with this color switch here. This was a $620 trade, and then losing here one time $100 trade, $100 in trading into this consolidation. Well, it was not that good. It's way more better to trade a trend. That means letting the market push out, doing the trend, letting the market push again, trading the trend.